So that's the benefits of the TTR strategy. But a number of you asked about, well, how does it actually work? And I've tried to simplify it as much as possible. So many of you will already have an accumulation account, so a superannuation account in the accumulation phase, where you're putting money into it. You're not currently drawing money out of your super account. Now, we're assuming in this scenario that we've got $200,000 in this account, and what you simply do is you leave a minimum balance, and the current minimum for Christian Super is $5,000. So you leave $5,000 in your accumulation account. With the other $195,000, you roll that over to a new account, which is in pension phase. So 15% tax on these earnings versus no tax on these earnings. So that's the key benefit of moving to the pension phase. So now you've got two accounts. Now with these two accounts, you can continue to make, if you're eligible, make your $1,000 contribution to it to get access to the $500 government co-contribution. Your employer continues to put your 9.5% superannuation guarantee contribution into this accumulation account. You might be boosting that with salary sacrifice contributions. So you continue to have this account open. You also may have insurances still in this account. So this account still works as it is, but it has a smaller balance, but hopefully growing balance with more contributions coming into it. With the pension account, it has the same 5 investment options within Christian Super. So there's ethical cash up to ethical high growth in the accumulation phase, and there's the same 5 options available in the pension account. So exactly the same investment options available to you. But in the pension account, you need to withdraw a minimum amount each year. If you're between 55 and 65, then that minimum amount is 4% of the balance. You've got to draw that out each year and put it into your bank account. Now, if you don't need that money, if you've got sufficient cash flow, then you can just choose to put that back into your accumulation account. Many people get concerned about moving to the pension phase because they say, I don't want to touch my super money, I want to keep building it. Well, that's fine. That just means that when you draw the money out, you can set it to an annual amount and you can then just direct it back into your super account. So you're not actually drawing down on it. You're just taking advantage of the tax strategy, not eating into your superannuation account. Now, finally, you'll hopefully get investment growth on your account as well, depending on which investment option you're in. And similarly, you'll get investment growth on your pension account as well. So there's the 5 investment options available on both accounts. So that's how the TTR strategy works practically.